Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I am going to walk you through the process of valuing Exxon stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Exxon is an oil and gas company. Its headquarters are in Irving, Texas. It is a direct descendant of John D. Rockefeller's Standard Oil Company. It was formed in 1999 by the merger of Exxon and Mobil. Exxon was one of the 6 largest companies in the world from 1996 to 2017. The company produces 3.9 million barrels of oil per day. Let's get started with the model. This is a large cap company, 190 billion market cap. They're trading at $45 a share and they have 4.2 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company did have positive free cash flow in 2017, 18, and 19, but negative in 2020. Net income is the profit and loss on the income statement. It's revenue minus expenses. They did have really strong net income in 2017 and 18. It dropped in 2019 and dropped further in the trailing 12 months. Revenue is the sales for the company, and that peaked in 2018 at $279 billion. It kept dropping each year after that. It's down to $195 billion. The reason for the lower revenue is due to COVID and also due to lower oil prices. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The difference is the gross profit, and that's the lowest in the trailing 12 months. Below that is operating expenses, and they did have negative operating income in the trailing 12 months. It was positive in prior years. It peaked in 2018 at $22 billion. Then below that is the interest they pay in their debt. They paid over $1 billion of interest. Below that is other income and expenses. And here's a breakdown of their other income and expenses. Half of it is earnings from equity interest. This is the profit Exxon received from its investments in other companies. That was $2.5 billion in the trailing 12 months. It peaked at $7.4 billion in 2018. The company also generated $2.7 billion of non-operating income. To figure out the details of that, you have to look through the 10K. Since the company had $5 billion of other profit, it did have positive pre-tax income of $4 billion, then $1 billion of taxes, and $3 billion of net income. That was their lowest net income in a long time. It peaked in 2018 at $21 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And free cash flow is the cash that's left over to pay a dividend, to buy back stock, to grow the business, or to pay down debt. And this company had negative free cash flow in the trailing 12 months. It's been a really rough year in 2020. I expect this number to improve a lot in 2021 and definitely in 2022. This company pays a nice dividend, but another way to reward shareholders is to buy back stock. And they bought back over $700 million in 2017, $600 million in 2018, and $600 million in 2019. When a company buys back stock, that decreases the shares in the market, which makes the remaining shares more valuable. This company uses a lot of debt to run its business, almost $13 billion in 2019 and $23 billion in the trailing 12 months. They needed this debt because they had such low free cash flow in 2019 and negative in the trailing 12 months, so they needed the money to run their business. The most important part of any business is their operating cash flow, and this company generates lots of operating cash flow, from $17 billion to $36 billion. The way you calculate operating cash flow, you start with net income, that was $3 billion. Then you have to add back the depreciation. That's an expense that brings down your net income, but it's a non-cash item, so you have to add it back on the CFO section. So even though the company only reported $3 billion of profit, they actually generated $17 billion of cash flow. That's why you should look at operating cash flow. That's a better indicator of a company's health than net income. Let's look at a capital structure. $199 billion of equity, $47 billion of debt. They're 81% equity, 19% debt. And their WACC is 10.5%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $283 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $229 billion. We divide that by 4.2 billion shares. And we get a calculated stock price of $54. They're trading at $45, so they're trading at a 17% discount. It's a buy according to the model. Simply Wall Street values the company at $890, so they're saying it's a really strong buy. That is a really high valuation. I'm not sure how they came up with a number so high. The way I calculated my future free cash flows was based off of the previous free cash flows and also based off of analyst expectations. The stock was trading about $100 back in 2016. It was coming down little by little over 4 years, but it wasn't coming down too much, just a little bit. But then it dropped like a rock when coronavirus hit in March. It's come back up a little bit, but it's trading at a major discount relative to its all-time highs, also relative to its price back in March. This company seems to raise its dividend periodically. It was 73 cents, now it's up to 87 cents. And they pay a 7.76% dividend yield. That's a really high dividend. And they pay out 443% of their net income. And the way you calculate that, it's annual dividend payment over net income. And remember, net income is not actual cash, it's accounting profit and loss. So sometimes this number can look funny. But the company generated negative cash flow. That's why they had to take on so much debt to pay their dividend. Their beta is 1.34, so the stock moves a little more than the market. The stock has gone down 26% in the past 52 weeks, much worse than the S&P 500, which went up 17% in the same time frame. The 52-week low was $30, the high was $63. The stock is trading above its 50-day and 200-day moving average, so it seems to be on an uptrend. This is a really liquid stock. 26 to 31 million shares are traded each day for this stock. Almost all the shares outstanding are on float, and about half the shares are held by institutions, and only 1% of the shares on float are shorted. If you invested $10,000 into this company 10 years ago, you'd have $8,300 today. There was an 8-year period of those 10 years where you could have sold at a profit, but if you're still holding, you would be down. Vanguard is the biggest shareholder at 8.5%, then BlackRock, then State Street, Geode, and FMR. Let's look at the financial ratios. The average PE is 11.2, the median is 14.4. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 57.1, so investors are paying $57 for $1 of earnings. Price to sales is stock price over sales per share. They're at 1.0, much better than the median average. Price to book is stock price over book value per share. They're also at 1.0, better than the median average. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have $199 billion of equity, $192 billion of tangible equity. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have a negative interest coverage ratio. ROE is net income over equity. They're only at 2%. Current ratio is current assets over current liabilities. They can cover 80% of their current liabilities with their current assets. And their current assets are $3 billion of cash, $27 billion of receivables, and $18 billion of inventory. So the company is going to need a lot more debt to run its business over the next 12 months because they did have negative free cash flow. They have negative $14 billion of working capital, and they have a $15 billion dividend payment. The best way to look at ratios is to compare them to similar companies. I've done videos on BP, Cannovus, Husky, Imperial, and Suncor, all in the same industry as Exxon. And if Exxon has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So everybody in this category has negative earnings except Exxon. So they do have a better price to earnings ratio than any other company. They have a really good price to sales and price to book ratio, but it's worse than average in the industry. They have a terrible current ratio, the worst in the industry. They have a positive ROE, so they're better than the average. They're lower in debt than average. And they're by far the biggest company of this group, and they also pay the biggest dividend. So to summarize, I have them trading at a 17% discount. I rank their free cash flow as 3 out of 10. They're really struggling in 2019 and the trailing 12 months. Revenue, I ranked 5 out of 10. It is such a big revenue number, 195 billion, but it's a lot smaller than previous years. They have pretty weak ratios, so I give them 4 out of 10. Exxon is a giant of a company, so it's not going anywhere. It may seem like a risky investment because the stock has not performed that well in the past decade, but for a long-term basis, I don't think it's too risky. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.